thank you for joining me today. My name is Wesley Boudreau, one of the advisors here with the Retirement Group. Today I'd like to welcome Southern California Edison employees and retirees to one of our webinars going over common 401k mistakes to avoid and some updates on various tax planning strategies. Throughout the course of this webinar, we'll talk about some various 401k mistakes we see from time to time, how we can help you rectify those and transition into retirement so you maximize your 401k plan. We'll also talk about some historical tax changes, talk about some proposed tax changes, how all this can affect you as you transition into retirement and how to minimize some of those tax impacts on that transition process as well. With everything going on recently at Southern California Edison, we think a lot of this material will be very appropriate for you. So with that being said, let's go ahead and dig into this.
All right, before we get into those topics I just mentioned, let's first remind everybody who the Retirement Group is. Again, the Retirement Group is an independent financial advisory firm that focuses on working with corporate employees and help them transition into retirement. The reason we only focus on a select few companies is it allows our advisors to have a deeper understanding of your specific benefits plans, whether it be the pension, healthcare retiree, the 401k, savings plans, things like that. And our goal is to help you transition and avoid a lot of mistakes that we see. So when you do walk out the door, you're maximizing as much money as you can from the company benefits. And we do have offices throughout the country, so rest assured if you still want to sit down face to face with myself or one of the other advisors in our many offices, you can do so. But obviously we can also accommodate you via webinar meetings, phone calls, email, fax, all that's available as well. If there's anything you take us up on though, at the end of the day is going to be our cash flow analysis. This is a complementary tool where we can actually let you see, are you on the right path for the retirement goals you have? And we can go in there and adjust those retirement goals to see if maybe you need to work longer, or could you retire earlier, or what's the best option for you on the retirement? Should you keep your 401k where it is? Should you roll it over? We can go through all those different options for you, but ultimately at least let you know if you're on the right track, and we can go from there. So as far as getting into some of the different tax situations we'll talk about, we'll go over updates on a minimum required distribution. We'll talk about the changes with the the non-spouse IRAs, talk about different tax bracket changes, the different marginal tax brackets, and then also some potential Biden changes which may or may not be going through at this point. Now that we're getting into the midterms. So first and foremost, there were a couple of different changes that happened back in 2020 thanks to the Secure Act. There were some good and some bad. So this was signed in December 2019 and acted in 2020. The first one's a positive. We actually stretched out the required minimum distributions from 70.5 to age 72. So what that means is whether you need the money or not, once you hit age 72 instead of 70.5 now, the IRS is going to force you to start taking required distributions from your 401k or your IRA or wherever your tax deferred vehicles are. So again, whether you need that or not, you're going to have to start taking distributions at a certain level, and we can go through that on a one-on-one basis when we run that cash flow analysis. The benefit here is they extended a year and a half, so they gave you an extra year and a half of potential tax deferral savings. Now for us, it's also a potential year and a half more of Roth conversion strategies, which we'll talk about a little bit later here as well. Another very negative aspect they changed, and unfortunately I had to face this twice early 2020 with some clients who passed away. It used to be that if you passed away and you left your everything to your spouse, he or she could continue to take distributions based upon their life expectancy or put into their IRA. That has not changed. The thing that's changed is if, let's say, you passed away and left something to your kids or other beneficiaries that were not your spouse, they used to be able to stretch that out over their life expectancy. Now they've changed it so they have to take that amount out, whatever's there, within the next 10 years. So they take it out, all at once at the beginning or the end, or take it out year by year. The best you could do theoretically is stretch it out maybe 1/10 per year. So let's assume that your spouse passed away first, and you guys have your nest egg, and it's mostly IRA money. And let's say you leave $1 million to just one child. That child hopefully is in their 50s by this time if you're passing away. They might be earning income, but they're also forced to tack on, let's say, 1/10 or $100,000 on top of that income, which means they'll probably be in a higher tax bracket. It's going to cost them more in taxes. So this is one way where the government, the IRS, is seeing that the transition for the baby boomer population, they can get their hands on some of that taxable money. So it does introduce additional tax planning strategies we can discuss with you if you have a concern of this. Another positive, it used to be that once you hit that RMD age of 70.5, you are not allowed to make any contributions to your employment plans, whether it be a Roth IRA or a 401k. But what's going to happen now is there's no age restriction. So If you are 80 years old and you're working at the hardware store, as long as you have earned income, you can still make contributions to a Roth IRA or a traditional IRA or an employer-sponsored plan if you have that there. So that is a good benefit they changed as well. Now, as far as the tax brackets, I'm not going to go into a lot of detail because the tax brackets have been the same for the last couple of years. They've just indexed a little bit with inflation. But I will highlight one as an example, if you would, for a common practice we do with most of our clients. And we look at reviewing their tax brackets once they're retired, closer to the end of the year, maybe October, November. The reason we wait till then is because there's no surprises. We've got most of the year behind us. We can take a look at what they've withdrawn from their 401k or IRA to determine roughly what their tax bracket is going to be. And then we'll see, okay, where are you in that tax bracket? So let's take a look at an example. Maybe we look at somebody who is married filing joint. And we look at their income, and their income is they're taking out, let's say, only $70,000. So if we look at that, that 70,000 puts that, that's going to be the second column down, puts them in the 12% tax bracket. Now, if we factor in standard deductions and everything, honestly, somebody can have a little bit over $105,000, and you use the standard deduction and still be in that 12% tax bracket. So for that couple who had $70,000, they're still $35,000 away from going from the 12% to the 22%. I would argue that 12% is a pretty reasonable tax rate, and we'll probably won't see that rate again down the road because it's likely we should see tax rates move up somewhere down the road. So they might say, okay, I want to take that $35,000, pay the 12% taxes on it now, convert that to a Roth IRA so it will grow tax-free, and we'll never have to pay taxes on it again as long as we keep it there for at least 5 years. So this is an example of a strategy we look at year by year with clientele to make sure we're maximizing that. So when they do hit that RMD age, there's less they're forced to take out, and they have more control over their taxes. And we'll talk about how tax rates could change down the road in a few slides or so. We've also got the capital gains tax on there. So again, if you hold something longer than a year and sell it in a taxable account, it's long-term capital gains, which historically has been favorable compared to ordinary income. It's either going to be 0, 15%, or 20%. And we'll discuss some potential changes to that as well down the road. Now, another issue to be aware of is where are you going to live in retirement? We talk with countless people that maybe retire in one state, let's say California, for instance, and move to Texas or Florida or Tennessee or somewhere where there's no state income taxes. So if we're going to run a cash flow analysis, we need to take a look at where are you going to be leaving and how are those state taxes going to affect you as well. There's also nuances where some states may have a specific tax bracket for your ordinary income, but they don't tax Social Security, or they don't tax retirement distributions if it's from a pension, but they do if it's from an IRA. So there's a lot of different nuances to be aware of, but obviously some of the main culprits like California, New York, and some other higher income tax states are definitely something to be aware of. And if you're thinking about changing one state to the other, let us know. We can run that cash flow analysis with both states to show over the long term how that would necessarily affect your long-term portfolio in that transition process. So we've got a year and a half or so under our belts with Biden in the office. There were some tax changes that already happened, and there are some tax changes that have been that we've talked about coming up. Now, obviously, moving into more of the midterms, there may be less of an option for that to happen, but it's still good to at least know. So some of the current changes that we did see kind of go through actually was kind of a continuation after 2020 with the CARES Act. We had some more stimulus come through there. The American Rescue Plan continued. We had some changes in the inflationary index used for the alternative minimum taxes. Had some changes to healthcare savings accounts and some child tax credits extended. So a lot of those were changed during the pandemic, and there are some questions: are they going to keep some of those or extend them, especially the child tax credit options and things of that nature? As far as some things that may be coming down the road, some negative aspects are the potential of raising the top tax bracket up to 39.6%, and also increasing the 3.8% on the Medicare tax as well for the higher income earners. Another big one is actually changing your long-term capital gains bracket from a 0, 15, or 20% to match your income bracket. However, it's been kicked around that's only going to be for individuals making $1 million or above. So that's not going to be most of us, obviously. So for most of us, we're not going to be affected there. And what scares me the most is whether or not they may actually eliminate the step up in cost basis. This factors in a lot of times we're doing NUA on a 401k, but it really factors into pretty much everybody that owns property or owns a house, owns art, whatever it may be that they're passing on to beneficiaries. Right now, excuse me, let's assume you bought a house for $300,000 and it grew to, let's say it doubled over time to $600,000. Right now, if you pass away, your beneficiaries will get a step up in cost basis of that $600,000. So there's no tax paid on that $300,000 growth. Hypothetically, if they did away with this and you passed away, your beneficiaries would have to come up with whatever the taxes are due on that growth of $300,000. And that could create a fire sale. They may be forced to sell the house just to cover the taxes. So that's the biggest fear we have as far as them potentially doing something like that. But if they do, hopefully they would understand the severity could affect everybody across the board, and there would be some potential changes or minimums associated with it there as well. As far as different tax planning strategies, let's talk a little bit about inflation coming up. We're right in the middle of it. We've been talking about this for a while. We'll talk about some different lump sum distribution options if you have a pension, the 401k rollover process, the conventional withdrawal strategies versus what we would possibly suggest. And then we'll talk about cash flow reports and how to actually review your situation from there as well. Now, inflation, we've been talking about this for the last year or two. We knew it was coming. The question was, when will it start and how quickly will it move? Obviously, so far in 2022, we've seen it move up dramatically. But what's going to happen is we've had such an increase in government spending. We've kept interest rates low, so there's more money flooding the market that way as well. That's going to drive inflation, which is what we're in right now. It's starting to drive those higher interest rates. It does create opportunities at different times, whether it be for your pension or for your 401k. But ultimately, the fear is it may also drive higher taxes down the road. Usually, if we have this much government spending, there's only two ways out. There's to inflate your way out of it, which we're starting to do right now, and tax your way out of it, or a combination approach. So we'll see as time goes on what will happen with that. When we look at inflation, these numbers are a little bit old. We look at March jumped up to 8.5% from 7.9% in February. For April, it dropped back down a tiny bit, and then it shot back up again for May. So we're at that point where we don't know if we're leveling out on inflation or not, but eventually we should get to a point where we do level out. Good news is the Fed's got more control, or at least they are showing more control than what they did back in the 70s, where the politicians, both Johnson and Nixon, kind of pushed them more to keep the rates lower. The Fed did kind of wait a little bit longer on this, but it looks like they're working as best they can now. So hopefully that will help going forward. But obviously it does not help us at the gas pump and everything we're looking at right now. So obviously inflation is a culprit to retirement planning, at least in the near term as well. Now, as far as the transition process, actually when you leave your employer, a lot of the companies we do work with obviously have a 401k plan, and some of them have a pension plan as well. In that pension plan, usually it's a defined benefit plan, in which case there is an annuity that you can get for the rest of your life. From there, you can decide to take a joint survivor annuity, or maybe you can take a lump sum if you want to take the cash and manage it yourself versus taking that lifetime annuity. If you take that pension lump sum, you have the ability to take that and your 401k and actually roll it over into an IRA account, so it's all tax deferred. There's no taxes on that transition because you're going from one tax deferred vehicle to another. You don't pay tax till you physically take that money out. Now, by doing that and combining those, it may provide you more flexibility as far as investment choices, the ability to work with a company like the retirement group or others, and it just gives you more control over those assets as well versus leaving them with the company. Now, when it comes to the 401k, we talk about some different tax planning strategies. This is one that we use a lot of times, especially with folks that want to increase their long-term tax benefit with their 401k plan. Most of the 401k plans that you work with are going to allow you to put in not just pre-tax, but after-tax contributions. So that means, let's give you a quick example. Let's assume you make $100,000 of income a year, and you decide to put 10% into your 401k. Generally speaking, you usually put that 10% pre-tax. So what happens is you don't have to pay tax on that $10,000 when you file your taxes in the year. Looks like you only made $90,000, so it saves you a little bit in taxes there. However, fast forward 10, 15, 20, 30 years down the road, when you retire, you're going to pay taxes on that plus the growth on it. The question is, where's your tax bracket at that time? The assumption always would be you're in a lower tax bracket when you retire. That assumption may not be the case anymore given where we are with the low tax brackets, but it is something to review. Now, the other option is you take that 10% or $10,000 put in, don't get a tax deduction right now, and so eventually whenever you take that money out, that $10,000 that you put in will be tax-free. Just the growth on it's going to be taxable. However, starting back in 2015, I think it was, they did make a change where you can take that after-tax money and roll it directly over to a Roth IRA so it can start growing tax-free, not just tax-deferred, but tax-free. So we call this kind of a spillover contribution. If you've got after-tax money in there already, you can look at potentially doing this. If you don't have after-tax money, you want to start saving after-tax money into the 401k because there's higher limits there. You can do this, and each year we can look at rolling that over to a Roth IRA. So you build that balance up, and that will grow tax-free and not just tax-deferred. So again, once you get that over there, you need to let it sit there for at least 5 years and wait till you're over 59 and a half for this to work out for you. But just give us a call. We'll be happy to go through this with you and show you the one-on-one how much tax savings that could give you over time. Now, let's fast forward. You are retired. You're not working anymore. You need to start taking income from your accounts, whether it be the 401k, an IRA, different taxable accounts. How do you pull that money out? What's the best strategy? Well, the age-old philosophy is that you don't want to pay taxes. You want to keep deferring those taxes as long as you can. So most of the time, most advisors in the past and most analytical tools, even tools we use today, will say you want to take your taxable amounts out first, continue to defer your tax-deferred money, and then focus on your tax-free money at the end. So this is the old school method, but let's kind of take a look at how that affects you. So if I were to actually zoom in here and we look at somebody who's retired, that first 2 years or so of retirement, the orange bars, they're blowing through their taxable accounts. So that maybe their joint account, their bank account, brokerage account, whatever it may be, but they're not paying any taxes because they don't have any taxable income. Then once they burn through that, they're going to start collecting their Social Security. They'll get taxed on that a little bit. Then they'll also start taking their IRA money and they're paying taxes on there. So now that red bar at the bottom starts hitting in where they're going to be paying taxes. Then eventually they may burn through that IRA money, and now they're just left with their tax exempt money. So they're not going to pay taxes again. So kind of a barbell strategy. There's little to no taxes on the beginning and little to no taxes on the end. But there's a better way to do this, because what you don't want to do is just simply not pay taxes and forego some of the benefits you have. Because even if you didn't have any income and you had the ability to take out withdrawals, you'd look at least the standard deductions are over $20,000, so you could take out $20,000 tax-free. So why not do that at least? So let's look at a different strategy here, in which case you're going to manage your taxes year by year, and this is where working with a retirement group or a firm that understands this can help you out, and that's making sure that you maximize your tax bracket, whether it be 0%, 12%, 22%, wherever you are. We can look at that. So zooming in here, instead of taking all that taxable immediately, you can actually take some of your tax deferred amount and still not pay taxes. Like I said, focus on the standard deduction, max that out, then take the rest from your taxable. And then what will happen is you'll have more of your taxable to last longer, and that means less of your tax deferred to touch each given year. So you can pick and choose different years as to what's the best strategy as far as when do you want to take those distributions. So that gets back into that Roth conversion we talked about before. If you've got less money in your IRA, you've got more choices on where that money comes from. If you got everything tied up in an IRA and you hit age 72, the RMD kicks in, you're getting what you're getting. You have no control over tax brackets, and tax brackets change every 4 to 8 years or so because of who's in administration. So it may be in the future that there's a year where tax brackets are very high. You want to minimize what you're taking out, or years where they come back down. You want to maybe take more out of your IRA or convert more to a Roth IRA. But again, it's all about trying to manage those taxes year by year because those codes change. So the best way to do it actually is, again, fill up your lower tax brackets with your tax deferred money each year. Make sure you at least max out the standard deduction. Beware of Social Security benefits, because there are taxation to those depending upon how much you're getting. It could be zero taxed, half it could be taxed, or 85% it could be taxed. Whether you are at full retirement age or not, there could be different taxation rules on it too. And then just strategically utilize the combination of your taxable, your tax-free, whether it be a Roth IRA or municipal bonds, also using your Social Security and your IRA money, and making sure you kind of play those together to find the best strategy. Now, whenever you decide to take distributions from your 401k or IRA, generally speaking, there's two numbers to kind of keep in mind. Age 59 and a half is where you need to wait before you start tapping into that. Otherwise, if you take withdrawal prior, you could be subject to a 10% penalty. The next age is now 72, the RMD, where even if you don't want money, you have to start taking it out. So between those that 12 years or so roughly, you've got some flexibility to do what you want when you want. Now, if you need to take money prior to age 59 and a half, there are some different ways to get around that, like a substantial equal periodic payment, whether it's for medical expenses, possibly first-time home purchase, college tuition. There are some options there. But one key thing is, if you retire from your company before 59 and a half, but you're 55 or older, there's the age 55 rule where you can take withdrawals, but only from the 401k plan without that 10% penalty. So be very careful if you're retiring between 55 and 59 and you're talking to an advisor who's telling you, hey, roll everything over to an IRA. They're thinking about what's in their best interest, not what's in your best interest. If we were working with you, we would tell you to keep at least something in that 401k So if you need to tap into it, you can tap into that without the 10% penalty. Now I mentioned again that RMD, we've talked about that a couple times. It did change from 70.5 up to 72. So again, at that point, that's when you're forced to start taking money out. So that's again why I mentioned reviewing taxes year by year prior to that. If we can slowly wind down some of those IRA funds and get them over to a Roth IRA, what that means is you're not forced to take out more than what you necessarily need, and it allows you to budget those taxes we talked about before as well. At the end of the day, all this needs to be kind of tied together with a cash flow analysis or a written plan. Right now, about 3/4 of Americans over 50 actually don't even have a written plan. If you can spend about maybe 10, 15 minutes with us, gathering some data, going over where you are, what you need for your retirement expenses, what you've saved so far between the 401k, the pension, outside savings, what Social Security is. We'll go through all that and let you know, are you on the right path? And we'll also tell you, we're not going to shy away from telling you, hey, you need to work 2 or 3 more years. Or, hey, if you want to retire early, you can retire early. So we'll go through all that with you and help you weigh the different pros and cons on the different options as you transition from the company, whether it be how to take the pension, how to take the 401k, and go through all those different items. Ultimately speaking, obviously at the end of the day, we would love to work with you. We'd love to make you a client. If you're working with somebody else already, that's great. We understand that, and hopefully you're getting the best service you can. We do recommend getting a second opinion periodically, especially if they're not focused on your company and understand your company plans. At the retirement group, again, our advisors focus on just a few companies at a time, so that way we have a deeper understanding, and we're there to help you avoid a lot of mistakes we've seen. And a lot of those mistakes we've seen can cost you tens of thousands, sometimes over $100,000 by simply retiring at the wrong day or not knowing the plan system appropriately. Also, you need to understand, what are you paying for at the end of the day? Whether you work and stay in the 401k plan or go to an IRA, work with somebody else, there's going to be fees somewhere. Obviously, 401k is going to be lower. Working with an advisory firm is going to be higher. But you need to make sure you're getting what you're paying for. At the retirement group, as fiduciaries, we are transparent on that fee structure. We're not a one-size-fits-all firm. So our goal is to run that cash flow analysis, help determine what you're trying to achieve, and provide you choices and go through the pros and cons there and get those costs down as low as possible for you. And ultimately speaking, like we said, you can't do any of this without running that cash flow analysis. So just let us know. Take us up on that offer whenever you have some time. If it's been more than a year since you've done one, let us know as well, because obviously things have changed between interest rates and the market, and we can update it. But by running that cash flow analysis, we can get a better understanding of you, and chances are you'll get a better understanding of your situation as well, so that you know what those next steps would be and making sure you transition appropriately. So with that, I'm going to wrap it up, and hope everybody got some information out of here. But if you have any questions, you can call us at 1-800-900-5867. You can reach at info@theretirementgroup.com. If you're tech savvy, you want to grab your cell phone, I'll hold this up here for a little bit. You can look at the QR code. There's one to get to us on our LinkedIn page, and you can follow along specifically for your company-related LinkedIn page. So we give you updates on interest rate changes or company plan changes. And if you'd like to schedule an appointment with myself or one of the other advisors in our many offices, you can get on there too, access our calendars and set a time up to schedule time with us. But I do want to remind everybody again, we do not work for your company. We are an independent financial advisory firm, but we've done extensive work with you, so we understand those plans inside and out. And then at the end of the day, if you have any questions, obviously, just give us a call at 1-800-900-5867.
All right, I want to thank everybody for joining us today, and I hope you enjoyed that conversation on common 401k mistakes to avoid and different tax planning strategies and how it relates to Southern California Edison employees and retirees. If any of you guys have any questions or you want to talk to one of our focused SCE advisors, feel free to give us a call at 1-800-900-5867. You can also reach us at info@theretirementgroup.com, or simply go to our website and use the Contact Us feature there. Hope everybody has a great day. We look forward to talking to you soon.